the technology really coming at the intersection of financial services really enables, two main things, right? I mean, education, Manish was talking about, but I think it's really about accessibility and that concept of accessibility, whether, robo or fractionalization that you just mentioned, or actually artificial intelligence, which, augments accessibility to information, right? Because of the vast amount of data that an AI can consume and summarize for us humans is quite mind-boggling. And now we're seeing it, firsthand with the generative AI, and we see really the application of it for our everyday life. But so the intersection of technology and financial services is really, really fascinating. And to me, it's really about accessibility, right? And if you anchor this into an example, which is fractional investing, right, or micro investing. So, I mean, at GTN, we're fintech, and we concentrate a lot of our efforts. We engage a lot of resources in finding ways through technology to bring down the barrier to investment opportunities, basically. And that means we, enable our clients, our partners, with the tools and the software and the technology that we bring forward to the fore. We enable them to, provide access to their clients and a broad spectrum of clients, again, right, from mass retail to mass affluent to high net worth, providing this path towards investment opportunities and therefore, wealth creation. And I think to embed all this into an example, like fractional share investing or fractional bond investing, is really attractive for investors, whether they are short-term or long-term investors, because they are now able to capitalize on specific market trends, and having access to products that they may not have had access to if it were not for the ability to have bite-size access to those bonds or those funds or those shares, right? Without having to outlay a large amount of capital and therefore, bringing down this barrier. So accessibility is one aspect, obviously. But the other aspect, which is, consequential to the accessibility, is that, those investors can diversify their portfolios in a much more effective way, whether it's pre-packaged for them or whether, they DIY, diversifying their investment because they have access to bite-sized, products that they can invest into is extremely important, because then you have, an investment, a portfolio, and a journey that is a lot more balanced, a lot more risk return adjusted, in relation to what you're trying to achieve, and that gives you, in the end, the flexibility to be able to come in or out or adjust your positions, your portfolios, depending on where you stand in your life journey. You can adapt your investment path accordingly. And I think this, basically gives real life to the term of democratizing, access to investing and investment, and creates a lot of financial inclusion across the different segments, and obviously across geographies. And this goes, I think, to your point, right? This goes hand in hand with other aspects of how the world evolves, right? Whether it's through crisis or through evolution. Mobile penetration is extremely high in Asia, right? Probably the highest after the US, and obviously much higher than other parts of the world, like Africa, for example. And that obviously pushes, the financial services to leverage that advance, that penetration, and bring, technology into financial services, into the hands of, millions, if not hundreds of millions of people. And I think that's what, technology can really bring to the world of financial services and the world, at large. So I'll keep it at that for now.
I think one of the biggest changes, and it touches on something Julian said, one of the biggest changes we've seen in client portfolios over the last 10 years has been the rise or the draw towards thematic investing and the ability to do that. And an ability for investors to play some of those mega trends, whether it's AI or cybersecurity or clean tech or healthcare, those have really shaped, how they structure a large part of their portfolio today than say versus 10 years ago. And I suspect, and I don't have data to support this, but I don't suspect this is a generational thing. We see that across the spectrum from established first generation family office investors right the way through to Gen Z and millennial investors. So I think that rise of the thematic investment, the ability to express a view thematically like that has really dominated the landscape. You touched earlier on the point about passive and active and ETFs, and I think that's fairly well understood. I think what drove a lot of that, and rightly so, was an awareness of the of the costs associated with active management. And again, through technology, you've got the ability to essentially buy the market beta very cheaply in a low cost fashion. That's how I define passive investing, those index trackers. Some of the other ETFs are very active in nature. So I think those have been some of the biggest changes. I think something also which Julian touched on earlier about accessibility is key, because what we're also starting to see is investors now are almost historically would say look to private banks to typically access product. They're now going directly to the institutions and the providers because they can. And that's linked very much to that technological piece where whether it's the private equity hedge or alternative manager, they've now got embedded technology on their platform that allows them to take on smaller clients, smaller bite sizes. They kind of used to be set up just to take institutional size checks, but now through fractional ownership, they're directly targeting the family office, ultra high net worth market themselves, and have an ability to take those smaller check sizes in a way that perhaps didn't exist 10 years ago. And that's creating a challenge for, say, traditional private banks, because many of them have tried to differentiate themselves over the years by providing proprietary access to certain product on their platform. And it was often typically, a private equity or a hedge fund or an alternative investment, but now those investors can go directly. So that's certainly one of some of the changes that we've seen. One point I would make just on that thematic investment piece generally is we've seen examples where clients have ridden that very successfully. So the AI thematic, which has been playing out ever since sort of May last year when NVIDIA's Q1 results came out and the launch of ChatGPT, we've seen a lot of our ultra high net worth clients really playing that. But an example of a thematic where perhaps it hasn't worked as well for clients was I think a lot of them were very late to the party for clean energy. And actually, in this higher rate environment, a lot of the sort of dirty energy stocks have outperformed them. And in the high rate environment, some of the clean tech firms, that's impacted those growth tech firms. So it's not always a sort of panacea. You can, you've still got, I think just because you've got access to that thematic suite of investments, you still need, good advice in order to sort of shape those portfolios. I'll pause there.
What you can see from everything that Julian has said, that Robin said, and that I'm saying is, I think technology is everywhere in financial services and in wealth management. So fintech is actually just another term for financial services. There's not an aspect, whether it's ETFs, whether it's portfolio construction, fractional, it's all enabled by technology. And so, where we are today, I think we're going to see more and more improvement in accessibility and education because of technology. But really, Robin touched on it. There's been this wave of AI that's really enthralled everybody, not just investors, but almost everybody. I can't remember anybody I've spoken to in the last 12 months that hasn't told me something or talked about ChatGPT and what they've done with it. And, what you can see in the very near future is that the real disruptor, the real enabler for something amazing is going to be the combination of a large language model like ChatGPT with data that's coming out of your bank or your banking environment. So probably, it's definitely going to be led by an Asian organization because, as Julian said, Asia is mobile first, but what it also is digital payments first. So many individuals across Asia, they do all their banking on their app in their pocket. Whereas in other regions, we might be mobile first or have high penetration of mobile, but we still use desktop banking, we still use traditional banking. And so, the digital rails are there. When you put together large language models with data and the ability to construct portfolios in increments and access different markets, you end up in this hyper-personalization environment where you literally have a financial advisor in your pocket that you don't need to tell what to do. It can react to what you're doing. So if you're overspending or underspending, it can sell or buy into the market based on your cash reserves. In your case, with the situation you talked about with the hotel being isolated in China, there's a potential to use geolocation to say, well, I'm in a place where I might need more cash reserves, or I might need to prepay some of my financial commitments because I might be stuck here for a period of time based on news and geopolitical data that's coming. So I think, we can extrapolate into the future, but I think it's not far away that we'll end up with almost a personal advisor, personal banker in our pocket that we set the guardrails on, and it does what we want, but it also learns from what we do and personalizes and optimizes our portfolio in every sense. And I think we've seen the first version of that with early stage robo-advisors. They work really well in terms of optimizing your personal investments. They leverage fractional and ETFs to keep you invested in the market. They're able to diversify into really interesting thematics and trends. But imagine that on a much larger scale with a family office or with a private bank or, with an institutional investor where you're wrapping all these technologies together. So I'd say that's the big game changer from a short term, 24 months to 3-5 years point of view. I think blockchain will totally disrupt the way we engage and buy and sell and transact on every scale because it rewrites the rules of contract, basically. It changes the ability or it changes the requirement to have a counterparty. It changes the way contracts are built and settled. And so less so blockchain and more the smart contracts capability that exists within blockchain, I think will totally rewrite almost how everything happens, not just in financial services, but in traditional economy. And that's not talking about Bitcoin or anything like that. It's actually the technology.
I would go just if you allow me, I would just go one step further, actually, because the point you make is very interesting on hyper personalization. But I think ultimately, and that's probably 10 years out, right? Ultimately, you will see that hyper personalization and the ability to have an advisor in your pocket will come as an everyday fact of life, right? And that is why at GTN we're very interested and super excited about what can be done with the principles of embedded finance, right? And so when an investor doesn't have to wear the investor hat and start thinking about financial planning, about retirement planning, about diversification, risk management, because those are all concepts that you can be educated on, and that we are still as an industry thinking and trying to get our hands on as far as communicating and indicating our customers and our customers' clients. But I think in 10 years' time, embedded finance will be bringing, these investment opportunities and wealth creation pathways, as second nature, basically. The way you think about walking back to your house, that, yeah, you need to pay your bill tomorrow for electricity, or you forgot to buy some milk for the weekend. It's just second nature. And I think financial investment, access to, to financial planning or the likes, needs to be as second nature as, everyday life action or matters, right? And so embedded finance, I think, achieves this because, when you go on your super app and you can obviously order a taxi and, buy a delivery for your lunch, and maybe save some money because the super app has some digital banking capabilities. It should, obviously, with the advance of technology and AI and machine learning, it should enable, whatever cash you have within the parameters that you don't even have to set ultimately, that are set for yourself because it detects, understands, and tracks your behaviors. It will set you on a path that is, commensurate and aligned with what is the path you should be on. And so I think that's super exciting, super interesting. And I don't think that's futuristic or science fiction at all. I think, in 10 years' time, I'm pretty sure my kids will not think about banking. It will just be part of what they do. They chat, they eat, they interact, and there is some financial elements into it.
I think you're right on that one, Julian. I think if we think back 15 or 20 years back, cruise control in a car was a magical thing that you had to pay extra for. Now it's a standard, and full self-driving is something that we pay extra for. I think in the very near future, it will be full self-driving, full self-finance. It will just happen in the background, and embedded finance is definitely the way.